Thank you everyone for joining in today's webinar, which is the three C's, cost, capital, and compounding. Heartily thanks to all of you attending the webinar. We'll just quickly start. Good evening, everyone, and welcome to what I believe will be an incredible and valuable session. This side, your host, Manish Panwar. I'm a chartered accountant by profession, over 10 years of experience in corporate finance and investor relationship. Today's webinar is hosted by Exchange Talk, powered by Zoom. Exchange Talk was born out of a simple realization: India's founders, HR, and finance leaders lacked a space for honest, purpose driven conversations that lead to real outcomes. Exchange Talk is launched to create a space where leaders don't just attend, they belong, a platform that sparks real conversation, build meaningful relationships, and drives collective progress. Today, we are diving deep into something every finance leader may struggle on a daily basis: how to drive and sustainable long-term business value. And that is what our topic is. And we are exploring this through that what I call the three C's of finance: the cost, capital, and compounding. In today's market, where capital efficiency isn't just nice to have, but it's a survival, these three levers can make or break your business trajectory. I have brought together three exceptional finance leaders with me as our guests today on this webinar, who have mastered this balance across different scale and industry. Let me quickly introduce our panel and then we start today's webinar. Our first guest, Mr. Tanmaya, who is having more than 22 years of working experience. He was a CFO of RateGain, driving financial strategy in the travel tech space. Our second guest, Mr. Nikhil Agarwal, again a seasoned finance leader with over 22 years of working experience, currently working as a senior finance director at Browser Stack, scaling financial operations in the developers tool ecosystem. Our third guest, Mr. Prasad Nair, CFO ESOP, with having more than 30 years of working experience in the finance domain, specializing in equity financing and wealth creation strategies. And before we move and finally start today's webinar, here's how we'll be spending our time. We'll explore each of the three C's through targeted discussions, then open it up for your questions. We'll wrap up with actionable insights you can implement immediately. Let's jump right in. Before we dive into the framework, let's get to know our CFO as leaders. So to all three of our guests, I'm going to ask each of you to distill your entire CFO philosophy. So we'll start with our first segment, which is the cost. All right. So let's start with our first guest, Mr. Tanmaya. Tanmaya, the first question over to you, and then we'll begin the webinar from here on. Having scaled RateGain over nearly 10 years, how did your philosophy on cost evolve from early stage to post-IPO stage at RateGain?
Thanks, Manish. It's a pleasure to be here and speaking here. Look, cost is a function of affordability, right? So when we're small, obviously many costs we couldn't afford, so the decision was very easy. But as we scaled up, and so there was many cases where we had to decide whether to spend, not to spend, and what to expect, etc. But I think it's a very important for a CFO to be very clearly understand what is a cost and what is an investment, right? So the cost needs to go down, and you continue to need to invest, and where you need to expect the return on investments. And I always say that any particular investment that you are making or spend that you are making, where you have those success criterias and everything that you need to track, a mediocre success is worse than a failure. So you need to fail fast, so that you can take the corrective actions and reinvest the money somewhere else if you really think that's not going to work. But if you face mediocre success, then you continue to invest in that cost, and and you don't get the success that you need. So it's a very fine line. It's a lot judgmental, some instincts that you need to apply, and based upon that, you decide on that. So as we progressed, we scaled up. It was always a decision between whether it's a cost or it's an investment, and what are the success criteria of those investments that you need to track and take decisions whether I need to pull the plug or reinvest more. So those are the changes that we needed to apply.
Thank you. Thank you. It's a great answer to this to start with our today's session. Following with this answer and the question before, I'd like to also ask, like, how do you spot hidden costs that don't show up on a regular dashboard? There can be a number of examples to it, right? So there are a lot of hidden costs on a day-to-day finance operations and strategic finance roles, but maybe it is appearing out of a financial year close, or maybe at a time of a MIS or a quarter close. So how don't you show how do you spot hidden costs and around that?
Yeah, there are a lot of analytics that we used, in crunching the numbers. And I think one of the best ones was benchmarking your costs of the revenue as a percentage of revenue to the industry, right? So so for example, if the operations cost is more than the industry benchmark, or the engineering cost is more than the industry benchmark, then that's a red flag. You see like something wrong is happening, or the SG&A cost is way off than the industry benchmark, then you understand there is a problem. And then the second point, and then you deep dive and see what's happening, whether there is a lot of manual processes that need to be automated, or there's some digital transformation that needed to be done. So all those things, you can deep dive. I think the first step is obviously get into analysis, and that's the FP&A team has the bigger task there to find out whether we're wasting money somewhere, right? Same as at the revenue side, any revenue leakages that you can identify. So I think to start with, it's a number crunching, comparing with the benchmarks, and then you find something odd, you deep dive and see what kind of automations and what kind of efficiencies that you can bring in to arrest that hidden costs.
Thank you, Mr. Tanmay. So on this line, we'll definitely discuss in the time to come. The cost and the growth goes hand in hand. So sometimes you have to just put one as compared to the other. So we'll come to that. Nikhil, coming to you, at Browser Stack, how do you manage cost while scaling globally, especially in a tech infrastructure, hiring and go to market? Like, there will be two various broad areas where the major cost decisions are being taken. So would like to ask you, like, how do you manage cost there, right, when it comes to cost and cost related decisions?
Yeah, I think whether you're global or local or different scales, I think I love the one thing Tanmay said about affordability. When things aren't affordable, decisions are very simple, right? It's a matter of filling your stomach rather than figuring out what gourmet you'll have. But when you start scaling and you have money in the bank, that's where I think the most important aspect is metricizing, right? Is a long, old saying that you can only control and optimize what you can measure. So unless you're measuring and metricizing, you will lose track, and which is what, in my world at least, you'll always see, where you're metricizing every little thing, right? Obviously, it's not about multiple metrics, but metricizing everything that matters, every place that you're investing. Like you said, even if it's tech infrastructure, right? The most heaviest tech infrastructure you'll see in a data center, and at Browser Stack, we capture, for example, revenue per device, or profitability per device, cost of operating a particular product out of a data center. There are various metrics which help us see, are we optimizing resources at hand? Then you need to make an investment. Again, you go back to your metrics and you say, if I put X, what am I going to get? Like Tanmay also hinted, you have a business case and you track very close to it. Another beautiful thing he put out there was about failing fast. That's the other thing. You don't need these metrics to be measured at the end of a quarter. You the basis of your decision, you keep looking at it quickly, and you try and realize as early as possible if this is a success or a fail. Right? And you could apply that theory to anything. I mean, cloud costs. You could be looking at cloud cost per session of running a SaaS tool, right? And that just tells you every customer interaction, every customer interface on your tool, on your platform, what is it costing you? At times you'll have benchmarks like Tanmaya mentioned, and you can compare across industry. At times you don't, because a lot of the tech world is private. There's not a lot of data available at times. But then you benchmark to yourself, right? I mean, you benchmark to yourself and you realize, at least am I doing as good as I used to? Right. I think it becomes a little more trickier, like you said, when it comes to hiring. Because hiring is, I consider the holy grail of cost traps or investment traps is, do I push a product feature out faster and hire more engineers to do this? Or do I not invest in additional 20 engineers and then let this feature come around? I think at least in my world, we've sorted that out also through a lot of business case building and metricizing. I think a feature is only as valuable as the money it will bring in the quarter following its release, or in the next few quarters. If you can get that alignment between what are you building, why are you building, and then come back to the pace of building, that helps you sort those sort of fundamental traps of investment. And I think Tanmaya was very right. It's not about, everything's not a cost. If it has a successful business case, it's an investment, right? And then investments take a different point of view, particularly. So in at least in my world, when I'm looking at these things, there's a lot of metrics. There's a lot of looking at them very frequently and failure, recognizing failures very quickly, right? Or mediocres very quickly.
Right. So quick takeaways for the session till now is, one is definitely it's also learning for all of us, especially for me as well. Like early failures are much more important than the mediocre success. That is very true. Not every time what we put into place, what we put in, what we formalize, what we draw in Excel is going to come out as equal what the Excel formula says, right? So very good point. Early failures is much better than the mediocre success. It will show us the true picture at the right time. Second takeaway from the session is, like, if you cannot monitor, if you cannot measure, you cannot monitor and cannot take corrective actions on time, because every business wants to grow at a pace, and that pace cannot be measured. But yes, at the same time, the business, the matrices, the cost, the alignment, allocations, everything, those areas should be measured and must be measured. And that's why there are a lot of tools, lot of solutions, lot of new product are evolving in this world, right? Especially in the SaaS field, when the money is the key cost is the key factor, right? And the third one, right? There are n number of cost elements every business may have. You have one source of revenue, but multiple source of cost allocations. Ultimately, all cost investments are aimed to get that revenue keeps growing on. Sometimes revenue is not growing as per the budgeted or as per the plan, but if the costs are being controlled, costs are being optimized by deeping down into the lowest level of that unit economies, yes, the business will thrive and not just survive, right? Moving to the next question, Nikhil. First of all, thanks for that wonderful insights over that tech infrastructure and the related cost. Coming to the next point, to you, Nikhil. In a high growth company, how do you decide what to cut and what to protect? This I also touched in when Tanmaya was answering, right? There are a lot of proposals being put in on the CEOs and the CFOs table, a lot of new tools. Every function wants to automate, to optimize, to make best out of their resources, to provide best of the resources and facilities for the business and for the ancillary functions related to business, right? But at the end, when you have to pick option A or B, so what to cut and what to product, right? While you are optimizing costs, or maybe while you are creating a next year budgets or AOPs. So how would you suggest, or how would you recommend to our audience, like what all areas to look after?
Great question. I think, there are two parts to this. I think one is just sort of cutting or optimizing a cost base versus what do you invest in if there are multiple competing proposals in play. I think while they're different, they're very linked. In my view, if you got into the first, where you have to cut a cost base, then you didn't do the second properly. You failed as a finance function. You've actually failed the organization, and you let them put money where, or let them continue to put money where it wasn't thriving. That's why you've gotten into a place where you now have to cut. So second one's very important. When there is a proposal on table, you need to spend extra, whatever, 5 minutes or 5 days before you take that decision, whatever amount of time, but extremely important to be nimble and slow at that point. That's how I feel, because if you take a decision in the rush of, oh, X is saying Y will happen, let's go do it. Right? It may be right, but spend extra 5 minutes and figure out if the Y is going to happen, etc., etc. But also, what are my milestones? How am I going to judge, coming back to the earlier theme of how am I going to judge, is this working or not working very quickly? Right? Whichever investment proposal is there, two main things to do. One, how does it connect to growth? Right? Is there the clearer the path to growth, the higher the probability of you putting money into it, the higher on the priority matrix it will sit. And then if it's connected to growth, how am I going to know, are my assumptions holding or not? And whatever is clearer on the two of those is what will sit on higher priority for me to invest.
Right.
And honestly, there is amount of time to be spent here. I think I'd rather sit with my executive leadership and say, guys, let's spend 5 more minutes on this and take this decision once and take it right. Because we don't ever want to be in a situation where we say we've overinvested or we've overspent.
Correct. And once we have taken that decision, once that cost has been implemented, maybe in the recurring cycle or the next renewal cycle, we may step not putting that money into that area. But for that period, by the time we have already invested or already put in that money into the new proposal or a tool or a area, right? I think it's the responsibility and ownership of that cost owner as well. Maybe sales, maybe marketing, maybe tech team, right? Whosoever is bringing that proposal on the table. CFOs and CEOs or maybe management may be just approving it by doing all those evaluation. But if I have proposed a tool, if I have proposed a new maybe XYZ thing, right, where the cost is being involved, it's my responsibility as that head of function or maybe that proposer who have put this thing in the company, right? I should also be on top of it. What I have invested there, what I have asked for that, and what kind of a ROI I'm generating. Maybe it's
absolutely. I think I coined a small phrase for myself, and I talk about it a lot. It's called commercial consciousness. I think the one thing modern organizations, every individual needs is commercial consciousness. Every decision has commercial outcomes. Nothing is not without an impact on a P&L, right? So commercial consciousness is extremely important. And at least the way we sort of look at it culturally is that every individual, whether it's a function who's looking to spend, whether it's procurement who's looking to buy for the function, the CFO that's approving, everybody applies commercial consciousness and figures out an answer of what is right according to them. Collectively, then you come as an organization and say, this is my right investment and I will commit to it, not for a budgeting cycle, but for an outcome. The outcome may be multiple budgeting cycles, it doesn't matter, right? But right. I commit to it for the outcomes as an organization, everyone put together.
Right. Can't agree more on this. Moving to Mr. Prasad. Mr. Prasad, the last part of this cost segment. At ESOP Dhan, how do you approach cost allocation in a fintech where product innovation and compliance both demand attention at the same time, right? A new feature demand, a new kind of a product, a new kind of a workflows are a continuous demand from a business development and the sales team. At the same time, those compliances, those RBI, those banking related stuffs, especially in your space at ESOP Dhan, how do you manage that? How do you approach that cost allocation?
Yeah, hi. Thank you, Manish. Thank you, Nikhil and Tanmaya and the participants. Okay, so when you speak about ESOP Dhan as an entity specifically, we are a registered or a regulated entity. We are a NBFC. So when it comes to the compliance, is always comes as the priority. Correct? We cannot compromise anything on the compliance part. So as a regulated entity, is always complaints come as the top priority. When you come to cost, cutting or spending on it on the compliance perspective, when it comes to compliance, you don't see the cost, correct? you will always try to approach the best service provider who can actually be on the top of it and get the complaints taken care properly. So that is where we see as complaints. Okay, once it is coming to it's coming to the innovation side of it, for any entity to be relevant and sustaining, innovation is definitely the growth engine of any organization. Correct. Let me just try to give one example, maybe a very recent transaction what we have done to cover both this point, specifically to ESOP perspective. Because we have done one transaction recently where around 200 employees were participated in one company. So we are a ESOP loan provider, correct? So we have disbursed the loan to around 200 employees of one organization. Okay, when the company has shared with us the employee data, so usually when any company coming to allot the ESOPs, which will always come with a timeline. The timeline may have various relevant points to respective organizations, which may be a upcoming, funding session. The valuation will change, so it always comes with a relevant cutoff time. So the execution or the disbursement of the loan is the gist of it. Correct. We have to really be on it. So when we received the data from that organization, around 200 employees, and with a timeline to disburse the loan, in the 3 working days, actually, we disbursed the loan. So imagine 200 employees coming and we have to complete the complete KYC of each and every employee, and then come to the loan sanction letters and the loan agreement and the pledge agreement. All these things to complete on a timely manner, you have to be having a proper tech backend. So we have really spent money and time on the developing the correct text backend, and there is why the faster and the speedy and timely implementation of it, or a timely dispersal of the loan was, really we could achieve it. But if we speak generally about on a regular companies, again the innovation comes in. Actually, you may have many real life examples in front of you. Correct. You see Nokia as a brand. When all of us started using a mobile phone, maybe I don't see like anything other than Nokia was there in the market. Correct? But you just see where are they standing today. Like maybe we have multiple examples like that of BlackBerry, or that for matter that Premier Patni or Ambassador, or many or Kodak, the film company. Many of them are vanished because of not doing maybe market adoption or the innovation side of it. So for any organization to sustain or to grow, definitely one has to come to the market reality, adapt and innovate to keep growing the business. That's the way I will see it.
Thank you so much for this segment. Moving to our next segment, let's shift gears and talk about capital, which has evolved from a treasury function to a strategic CFO weapon. All right, we have discussed much more in detail about the cost. Now coming to the capital, which will enable the cost decisions, right? So starting again from Tanmay, my first question will be in this regard, in the capital segment, will be what were your capital deployment priorities at RateGain and your other previous organization? And did they shift dramatically as you move closer to IPO? Because in this scenario, a pre-IPO or a unlisted entities, plannings, roadmaps, visions, and an organization which is preparing to launch IPO or which is already listed, there can be 2 different mindsets. So how your capital deployment priorities change dramatically when you move closer to IPO?
Yeah, I don't think it changed a lot, because IPO is an event, right, in a company's life. So you have always a long-term perspective, how big you want to be. Doesn't matter whether you're listed or not listed. But I think from a capital allocation perspective, it's a huge task for the CFO to allocate the right capital to the right area, because cash is king, right? So and I remember during COVID times, like we had to preserve cash and all to allocate whatever it was required. But I think at the end of the day, capital and profit solves a lot of problem for the company, right? More profit solves most of the problem. Capital obviously is handy. It needs to be preserved, but it needs to be allocated in a proper way. Look, we are a software product company, so the most of the allocation that needed to be done was on people, product, maybe geographical expansions and inorganic expansions, right? These are the four areas that we needed to invest more, and that I don't think that has changed over the period of time. Those are the four key areas that we always look at, where we can get the most ROI, uh, where we can invest this much and we can expect that much in next 2 to 3 years. So those are always a plan that we prepare, and I think Nikhil pointed out the commercial. We call it commercial acumen, and he called it commercial consciousness. I think commercial acumen is really required for a CFO to have, plus the two levels down below, as well as the leadership team or the P&L owner who is asking for that money to be invested. So I think that's a very good trait that need to have. Even when you are interviewing leadership teams, I think this is one of the trait that I look for, whether the guy is have a commercial acumen or not. So yeah, I think these are the four areas we always allocated money. But again, there is no set percentage that we allocated for each of the segments. Obviously, it came as and when the case came in, and we evaluated and we invested, and that's how we did it.
Right. A quick follow up to this only, like most of the times, apart from this internal stakeholders and the decision makers, we have to manage investors' expectations as well. Like, so how did you manage balance investors' expectation with internal business needs, especially when growth on one hand and profitability on other hand? So it's a decision between growth versus profitability came into conflict, right? So you have a different expectation from different stakeholders.
Yeah, I think it's slightly different pre-IPO and post-IPO stage, because pre-IPO we had only two Series A, Series B investors, so we are much more aligned, what we wanted to do. In post-IPO, obviously we hear diverse views, like from investor growth or profitability. Imagine like when we're doing the road shows, it was all about growth, and when we did the listing happen post that, it was all about margins. So there is a balance that need, but luckily in RateGain, we are bootstrapped till 2015, and then post that, whatever fundraisers that we did was for inorganic purposes. So we always had a balance between growth and profitability. It was never growth at any cost. So there is a minimum margin that we would always like to maintain. And obviously whatever extra margins we are getting, we can redeploy that for growth, but there is always a balance that we always maintained, and that's probably the philosophy everybody should have, right? Obviously when you see that much higher growth can be achievable, yes, you reinvest. I think that in SaaS there is a very good metrics called rule of 40. So it's a combination of 20% combination growth percentage and EBITDA percentage. So if you are growing 40% and you will sacrifice the margin to be break even, that's okay. But if you are growing 10% but also losing money, that's not okay, right? So if you are growing like 10%, you should have a 30% EBITDA to have a rule of 40. So that's a great metrics to evaluate and maintain how you want to balance your growth and profitability.
So before moving ahead, this last question related to this capital and capital allocation. RateGain went public. Looking back, what were your biggest learnings around structuring and communicating ESOPs pre and post IPO? Because this scenario also gets changed. Unlisted ESOP holders may do not believe it because they don't know when I am going to have this money in my hand. But when you go listed, people start valuing it more. So what kind of a structure, how do you communicate it to your the ultimate beneficiaries?
Yeah, you are absolutely right. Pre-IPO, many people really did not know how much they are in, right? In terms of wealth creation. It was tough to explain, tough to even retain people, right? So, but I think things have changed dramatically. IPO, some people really made good money, and and it's easier to, and what I experienced that after the IPO, it was easier to explain somebody to go out of the way and put in the hard work for a company, because the back of the mind says okay, the share price will go up and I'll make more money, right? I did not need to explain that post IPO, whereas in pre IPO it was always a struggle. And luckily enough, if I look at the attrition rates post IPO, at least at the senior level, it has reduced significantly for the company. But I think the learnings would be that, we could have done a better job in terms of, it is more about awareness of the company. Those guys who had a ESOP event in previous life, they probably would understand that. But those didn't have, which is possible in a startup, they probably don't value how much they will earn. But it's a much easier life in terms of explaining what is ESOP or SaaS or rights post IPO.
So one quick learning is like one, if we are investing 1 rupees of a cost, right, at a bare minimum, at least expect for a 1.01 outcome, if not 1, right? So if we are investing something, so that my cost should be recovered, one. Second is creating more awareness among the employees, creating more awareness why it is important. Like if we talk about the ESOPs, most of the people do not understand what is being given, how it will be, how we will make money, what will be the taxation and all. So creating more awareness at that point in time.
Yeah, but apart from that, you are sharing your responsibility, because the employee also thinking that he is also a owner of the company, right? And it eases your you share a burden, you share a responsibility as a leader.
Right. And thanks to those blockbuster news comes out from when Swiggy ESOP buyback or liquidation, Paytm, Razorpay, thanks to all those big blockbusters, which has already created that sense of awareness and ownership. Coming to you, Nikhil, you have led the board and investor reporting at company preparing for IPO. What are some capital related decisions? I'm talking the same line of IPO. What will be some capital related decisions that shift significantly when IPO readiness becomes a priority?
So I think I'll echo what Tanmaya said. I don't think large companies, successful companies change track just because they're heading to an event or an IPO. And definitely sort of didn't matter to Browser Stack at all, right? I mean, we had a certain way of deciding things and certain objectives which kept continuing. But hypothetically, even if something changes for an organization when they come close to an event, it's not going to be the direction or the categories of decision. What may maximum change is the structure through which a decision is passed, right? Earlier, you may, when you're small and you're, really sort of in early stages, you may have like just the management team looking at things. As you go bigger, you have a more professional board. You bring experts from the market to sort of think through along with you, because the stakes become bigger, right? So the structure of how you take a decision may evolve through the journey from a bootstrapping to, doing series A, B, C, and then getting to an event. The type of decisions and what you invest money on doesn't change. That absolutely remains similar. Right? So it's just the structure, the way you come to a decision, how many people do you speak to? Because again, when you're bootstrapped, you're taking decisions for say 10 lakh rupees into a product and, etc. Suddenly, when you're a global company at a scale of $200 million of ARR, you're looking at spending $500 million on acquiring a company. Massively different. You need more than the expertise you built or your team. So you bring in a lot more people, you bring in some structure, you get more advice on the decisions that you take. And that's really what corporate governance and IPO readiness is about. Are you taking well thought out decisions? It's not about what decision. Swiggy, for example, you mentioned that, continues to burn money even though it's public. It chooses a business direction that its investors, including the public at large, have chosen to back. That's the direction of the company. It doesn't change because they went up.
Right. Thank you. And on the same thing, in the last section, we talk about this commercial acumen, the ownership of that cost owner, right? In the same line, how will you align internal teams, right? Say a product or a sales or any other function, when they are competing demands on where capital should go. So every cost owner or every proposal will have certain outcomes, certain ROIs, right? So how do you align those internal functions? Because sometimes budget may be a constraint, sometimes deployment may be a constraint, right? At this point in time, maybe something is right or not. So what's your take on this?
So I think the first thing we do is make any investment proposal nameless, right? In the sense that the company is not investing in Nikhil's project or Tanmaya's project or Prasad's project. Company is investing in opportunities to grow, which may be product-led, which may be sales-led, which may be marketing-led, etc. But it is a combined effort of the leadership team with the absolute holy grail of a target, right? Growth. So all of us at the leadership team will come together and say, here is how this growth proposal looks like. They all need to combine behind all proposals because they are all growth engines. So it's not about product versus sales versus marketing at all, right? Now, collectively, there will be more confidence in the probability of one proposal than the other. And that's how we need to look at them, right? And this is a little bit of culture. I think very important to bring that, whether you call it commercial consciousness or acumen, that plus North Star metric of growth, profitable growth, sensible growth, being absolutely the North Star of everyone. If culturally you're there, you won't find it difficult to put everyone behind every proposal and prioritize basis probability of success.
Thank you, Nikhil. So quick takeaways. One, for the audience, one is that rule of 40, especially mentioned by Tanmaya, right? We can always put in EBITDA and growth margins and see where we want to go. Another is the direction where the business wants to go, which Nikhil highlighted very well. Like Swiggy is still being a listed entity, still they are on that verge of burning money because they have certain business direction. They want to do something else, right? And not every time same formula or same solution will work because there are factors, be it scale, be it industry, be it a new category creation, and be it what the organization at top wants, right? So there will be multiple factors which in absolute term as well as in relative term needs to be compared, needs to be evaluated before finally saying yes or no. Moving to Mr. Prasad. Prasad, as we talk about ESOPs, and ESOP done is more into that part. So ESOPs are a capital efficient tool for any startup, right? If I don't want to burn, I'm a young startup, early stage startup, I don't want to burn more money, I just launch a ESOP pool, I give a fixed plus variable plus ESOP as a compensation, right? So if ESOPs are a capital efficient tool for startups, what mistakes do you often see companies make while designing ESOPs from a CFO perspective, right?
Yeah, Manish. Okay, so we usually deal with the very matured startups, that is our target companies. We usually deal with the unicorns and maybe, the top 70, 100 unicorns. So when we deal with these matured companies, when you're talking about the policy framing and the documentation side of the ESOP policies, they are up to the mark. I never experienced any sort of issues in the framing of the policy, because usually all of them will come like the service providers like you to frame and implement their ESOP policies. So the policies are well framed and absolutely, I never experienced any sort of issues in the policy framing. But I will take a minute just to come to your second part of the question. The mistake, I don't call this a mistake. But to my experience and the way we dealt with the companies, I would like to highlight certain things, which may be important for all the startup companies, in the management as well as the employees. Okay, so you can actually go ahead and implement, and frame the best of the best ESOP policies. When it is coming to the implementation of it, if your intention for whatever the reason is not correct, then the question what all of us should ask now, whether the employees are actually getting the optimum benefit out of the ESOPs. So when an employee is joining a company, there is over and above the monetary remuneration, the employee is always counting on the value to be created on the ESOP side of it. Correct. Any employee will join an organization only after considering that. See, we are having around 100 plus unicorns, correct? Maybe another 100 plus unicorns, which is above the 500 million USD valuation level. If one go and see how many employees in today's time are the shareholders of any of these companies, I'll be shocked to see if the answer is more than 5%. So what is happening here? For some reason, the implementation, when it is coming to the implementation side of it, the company management, maybe the promoter or maybe the PE, VC investors who is sitting on the board of the company, they are not looking comfortable when it is coming to an employee becoming and sitting on the cap table. So in our experience, when you go and pitch a company, when you meet the CXOs of the company, we can see a greater amount of demand for a product what we are offering today. But when it is going to the board level, the approval coming from the board level, the board is actually not comfortable the employees becoming a shareholder. So instead, what is happening, if you keep seeing the ESOP liquidity programs, we keep reading in multiple companies coming back, to my experience, what usually these companies are doing, when the ESOPs are getting vested, and is an employee is going to try to exercise it, when they are putting a condition, in my experience, I cannot name the companies because of the reasons basically, but instead of they are allowing the employee to exercise, they're putting a condition, okay, if you want to exercise, and at the same time, you have to sell the shares either to the promoters or to certain investors at an agreed valuation. So they are creating some sort of liquidity to the employees, but they are not allowing the employee to exercise the ESOPs and hold and become a shareholder of the company. Right. Okay, let me just cover a minute to it, Manish. Okay, see what is happening here. There is a great amount of opportunity lost to the company. Let us take the tax arbitrage part. I'll just take a few seconds to cover that. See, if you are having, say, a company is an X amount of valuation, correct? And at that point in time, assume the ESOPs are vested, and if I go and exercise that when the valuation is in the lower side, when the company is reaching the IPO, it may be going 5x or 10x from that round of valuation. Then there is a great amount of tax arbitrage. The upside from your valuation on the vesting to the IPO time, which will get into the capital gain side, and the taxation coming from 15% to 59% is the game, correct? So because of whatever the reason, since the companies or the management or the investors are not allowing the employees to become a shareholder, the employee is actually losing a potential upside to ride the ESOPs and gain out of the optimum return to the employee. So this is to my experience is a serious issue which has to be taken. It's a great opportunity loss for the employees. So I'll be happy to hear from maybe Nikhil and Tanmaya, both of them coming from the startup background, if they can actually throw some light of this, or they disagree with what I'm talking about.
Yeah, I have a different view. Sorry. Employee by birth of being an employee should not have the right to be the shareholder, to be honest, right? So I think the problem lies where it's a time-based vesting, right? You, as an employee, you get the stocks and it gets vested in 4 years time, but you might not be the right guy to on a long-term basis, right? But you still own the shares. I think that's what hurts the founders. I think I have seen a lot of founders and the different viewpoints and all. Many give a lot of shares to a lot of employees. Many give only to the senior management who run the show. But I think if it's more performance-based vesting, I don't think the founders or owners would have a problem. But it's more of the time-based vesting is where the problem lies.
No, Tanmay, the issue is not of the vesting actually. Assume you are holding say 100 shares. The vesting may have a time-wise vesting or maybe an activity-wise of vesting. Correct. My point is, assume it is a time-wise vesting, and once you own the options, assume say first year the 25% getting vested, correct? So when out of the 100 shares, the 25 options are getting vested. My point is, if you as an employee got a right to go and exercise on vesting, correct? So now what is happening, even the shares are getting vested based on the ESOP policies. The companies are not allowing employees to exercise and hold the shares. I can give like n number of options. You can actually go and do, based on the public data, if you go and do a research on the unicorns and unicorn companies, the 100 or 150 companies. I don't think even more than 4-5% of the companies you will see the employees sitting on the cap table.
Right.
Yeah,
So,
and
sorry to
Prasad,
interrupt. And
sorry.
sorry to interrupt. In the interest of the time and to cover up all the Q and A's, I will just request if we can move to the next section, because we have a lot of Q and A's dropping in our chat box once again. But this gives us a new topic to discuss in more detail, like a CFO's responsibility and areas to look, where liquidity planning versus exercising financing is an area, right? We'll definitely deep dive. Quickly shifting to our next segment, the compounding, right? Now, the magic word compounding, this is where CFOs separate short-term tactics from the long-term wealth creation. Quickly, I'll go one by one with one question to each of you, and then we'll wrap up to the question answer segment. Audience is waiting to get their answers, right? So, to you, Nikhil, you have worked with deep analytics, right? How do you use forecasting not just to plan budgets, but to drive compounding improvement in performance as well?
Yes, I think the philosophy, like I started talking about metricizing, the philosophy is the same, right? When we were all sort of studying finance, we studied ABC costing, right? And metrics is a little bit like that. You create the metrics at the lower level, which is the cogs. You use your forecasting methods to work out how those cogs that move the entire machinery of your company will work. That helps you figure out how do you get to that compounded level of growth. What needs to change in each cog at different levels and leads to a compounded impact. Right? And the whole thing about machinery and cogs is little force and heightened sort of compounded impact on the output. And that's exactly how analytics and forecasting works on compounding business. You start looking at the little things, how to improve them by 1%, by a little bit, and all of that compounds into a higher business outcome. And that's really how you use forecasting or analytics to keep track of the cogs, make them move in the right way so that the car leapfrogs.
Thank you, Nikhil. Moving to you, Nikhil, Tanmay, in this compounding line only, what was a one long-term strategic bet you made and that paid off after years, right? Not immediate, but after some years, if you can recall in your experience.
Yeah, obviously over the period of last 10 years, we have made a lot of bets organically. Like we are a product company, so we invest in products. So we call them like baby products, teenagers and adults, right? So baby products are like the nascent phase where we burn money, but we spend, as I said, I go back to again that you need to fail fast and keep the success criteria to the true. So you need to track that. And then if they grow, then the teenagers grow into the adults. So making the first million is very tough, but turning it to a 20 million is much easier post the first million, right? But my best bet, I probably would say, in RateGain was in inorganic space. We acquired a company in the US in 2018 against our advisors of our investors, because the company was degrowing and also making loss. But me and my founder really had the belief that we can turn that company around, right? And we stuck to our gun and we invested in that company and we kind of turned that company around, and it was a real value arbitrage for us. So as I said before, that profits really solves a lot of problem for any company. So the previous company in previous management was not growing because it was loss making, the capital issues, etc. But once you solve the problem of profitability, and then the compounding really starts, right? And the 1 million attracts another 10 million. So that's how we did it.
So a journey from 0 to 1 is much harder than 1 to 10 or 100.
Yeah,
Right?
absolutely.
Thank you. Moving to the last part of the compounding session before we start and jump onto the Q&A session. We have discussed more on cost, capital, and compounding. In the last segment, we have discussed much more in detail about the ESOPs getting vested, exercise, and what are the different mindsets between a different kind of a founders or promoters or employees at different size of the companies. Prasad, one final question on this compounding part around ESOPs only. Just do you
Yes.
agree with me or not? ESOPs are all about delayed value, which we discussed in detail. What's the biggest mindset shift companies and employees need to make to treat ESOP as a compounding asset? Because we have seen a lot of good example over the year. So
Correct.
there's a mindset change is happening by these blockbuster news of Swiggy, Razorpay, Zomato, and all those things. What one point you want to highlight in this, right? What kind of a biggest mindset you want to highlight?
Yeah, so the ESOPs are definitely, there is no two way about it, that ESOPs are a very great tool, for on a company's perspective to attract and retain the talent. And at the same time, the employees to participate in the company's growth. Correct. So there is no difference of opinion there. So it's all about is how the fullest benefit of that the ESOPs should be given to the employees, and it is a long-term wealth creation opportunity for the employees as well. So they will definitely allowed to make the greater benefit out of it. If you just refer maybe a couple of months, maybe sometime back there was one article in Economic Times which is talking about around 35 non-promoter employees, made more than 100 crores from ESOPs. So, definitely there is no two ways. So the employees are creating value, and in today's time, the estimated value of ESOPs in these high growth companies are maybe around 17 billion USD. So it is obviously creating wealth, and the only thing is the potential upside should be given on the optimum return to the employees. That's what the company should really focus on and to drive it, basically.
Thank you. Thank you so much. Thank you so much, all three of you. This is fascinating. We are seeing a different types of compounding across financial, operational, and strategic dimensions. Right now, as we are at 5:55 p.m., so we are coming to the home stretch, and I want to make sure everyone leaves with something actionable. Right. So I'll move directly onto the Q&A session before we wrap up this session. The first question from Mr. Dheeraj Joshi: how to develop a long-lasting culture of cautiousness in the growing organization where major focus is on top line and delivery. So during our session, Mr. Tanmaya and Nikhil have highlighted it very well. So what would be the one solution, Mr. Nikhil or Tanmaya, if you want to take this?
Well, it's a top-down kind of culture, like the frugality in terms of cost is a culture, right? How you and especially from a CFO lens, I would advise that spend the money as if you're spending your own money, right? So I think that's how you can drive this culture. It's more cultural than anything else, I would say. Yeah.
Next question from our audience, Madhusudan Rao. The question is, what are the parameters to consider if any company is ready to move to IPO post Series C funding? I'll pass this question to Nikhil, but I'll just add a line like, again, I will always follow a policy of a relativity versus absolute. So Series C may not be a benchmark, because for a company, Series A is much higher than some company Series D or E. Nikhil, but over to you. What will be the parameter to consider if any company is ready to move to IPO post Series C funding?
Yeah, I think IPO is an event that you base on where in your business cycle are you, right? I think IPO, most companies would go because of 2 or 3 reasons. One, just the need for capital. I mean, if you need capital and you believe your metrics and everything is good for going to public markets rather than private markets, because public markets, there's a difference. Private markets, somebody sits on your board and creates, there is a sense of contained ownership and how they come and work with you in your business. Whereas public markets, it's public money. There's a different level of intervention in the business versus compliance and other requirements. So one is just capital. The other is you may need to go to markets because of exit routes that you need to give to your existing investors. Again, that's something you decided many years ago when you took on private money, and now you're fulfilling an obligation, right? And if none of those exist, then you really need to think about why are you really thinking of public markets. So it's not whether it's Series C or whether I'm 100 crores or whether I'm very profitable, all of that. It is the why. Do I need money? Should I rather go to private markets than public markets? What's the pros and cons of those two versus really sort of figuring out, is it an exit event? If it's an exit event, you're obligated to do it. You don't really have an option.
Yeah, I think just to add what Nikhil said, that's the number one aspect that we need to evaluate. I think the question Madhusudan is asking is whether from a documentation or readiness perspective or compliance, corporate governance perspective, they're ready or not. I think, yeah, Series C is a very good, by Series C, you would have gone through 3 or 4 due diligences and there is the corporate governance model, etc. I think from that perspective, you are ready. Because RateGain, we had only till Series B and we did not need to do any readiness assessment because we already had that kind of structure in place. So I would imagine if there are good private equities in your company, I think yes, from that perspective, you should be ready.
Thank you so much for your insights, Mr. Nikhil and Tanmay. Moving to the final question from Samida. What steps should CFO take if working capital is getting deployed towards investment in assets? The focus of management is always on expansion, but should it be at the cost of working capital? So there's a comparison is being created between expansion versus cost of working capital. So any quick suggestions?
Well, it's difficult to answer this question without getting into more details. But I would say, look, at the end of the day, the dollar is green. So whether it's working capital or capital doesn't really matter if you have capital elsewhere. But yes, if you are investing too heavily where or compromising your working capital position, obviously it will lead to a situation. But it's tough to answer this question.
So
I think the only difference you need to think about is what Tanmay said at the end. I mean, if you're compromising short-term liquidity into high things that will take time to turn around, long-term assets, that will eventually create a problem. And to that extent, I think knowing your cash flows and forecasting your cash flows and working with those helps any management look at reality, right? That if your cash flows need support, then you can't take that money away into long-term assets. I think that sort of helps you navigate that situation.
So, and final question to you, Mr. Prasad. When you are under pressure to show quarterly numbers or periodic numbers, whatsoever the frequencies followed. So when you are under pressure to show quarterly numbers, how do you personally hold space for long-term thinking?
Yeah. Okay. So this actually may be coming for the listed companies when you deal with it. Always it is, the quarterly numbers are very important parameter on a maybe more of the share price perspective on the listed company thing. So it's always comes under under pressure, and so obviously the number has to be in line with the company's business, and it is being audited by the statutory auditors and auditors. So it's more of that.
Yeah, I can add to it because I managed the listed company for last 3 years. Okay. So I think it's very important for the company to have a larger goal, say 10 years, 12 years, and then break it down to 3-year goal. And obviously the yearly and quarterly, but you will get the bumps. Like some quarters will be good, some quarters will be bad, but it's always better to give a 3-year plan rather than sticking to a quarterly plan, because you cannot look at quarterly numbers and run a company, to be honest. It always has to be a longer term vision rather than a chasing quarterly numbers.
So honestly, quarterly numbers only sort of manage pricing in the stock exchanges. I don't think they should, it's sentimental, and you as a CFO, you tell the sentiments of your employees and your management team, let's look at the next few weeks and this will pass over. But it's okay. Bad quarters are a part of life, and Tanmay said, if you focus on a 2-year, 3-year journey at a time, a quarter or two is okay.
Finally, thanking you, Mr. Tanmay, Mr. Nikhil, and Mr. Prasad, sir. Thank you for sharing such practical wisdom. What strikes me most is how all three of you view the CFO role not just as a financial gatekeeper, but as an architect of a long term value creation. The key insight we are taking away from the three C's are not independent, they are interconnected. Smart cost management creates capital efficient and which enables compounding returns, right? So thanking once again all the audience and the three speakers on the today's session, Mr. Tanmay, Mr. Prasad, and Mr. Nikhil. Thanking once again all of you for taking out time on this busy day at 5 p.m., which is the peak business hours in any organization. Once again, thanking. We also got a last question by the time we drop in. So, in a fast-growing SaaS business, where do you see the highest ROI in capital reinvestment? So, it's SaaS and capital reinvestment.
Well, build pretty good products. So I think it's people and product. That's SaaS business has these only two things. It's people and products. So
thank you once again for running this show, for running the sessions, for taking out these questions very practically, and I believe the audience has taken home key insights, many learnings, many key takeaways, including me. I have noted down more than 8 or 9 pointers, which will definitely help me grow in future and the times to come when managing these numbers, these situations in our organization as well. Once again, thank you, Mr. Tanmay. Thank you, Mr. Prasad. And thank you, Mr. Nikhil. I will hope to connect with you and meet with all three of you soon. And thanking all the audiences taking out time on a busy Tuesday at 5 p.m. during the office hours. Thank you once again. Thank you, everyone.
thanks. Thank you.
Thanks,
Thanks,
Manish.
everyone. Bye.